right, everyone, welcome back. Money Show is pleased to welcome Lyn Alden Schwartzer. She is contributing analyst to ElliottWaveTrader.net, covering equities, precious metals, and other assets using a global macro overlay. With the background blending engineering and finance, she uses a dispassionate long-term quantitative and qualitative approach to filter through the noise and find value in stocks and markets around the world. We are also pleased to welcome George Gammon. He's an American real estate investor and entrepreneur who produces and stars the Rebel Capitalist show. After 12 years as a successful entrepreneur, he's semi-retired and shifted into real estate, where he has remodeled and flipped over 40 properties in and out of the United States. Mr. Gammon is also a gifted teacher with a passion for learning and teaching macroeconomics through his website, georgegammon.com. George, Lyn, thank you so much for being here. It's all yours.
Well, thank you very much. I appreciate it. Lyn, you ready to rock and roll here?
I'm ready to go.
Awesome. I got to figure out who on earth wrote my bio. It sounds completely cheesy, doesn't it? Who on earth wrote that thing? All right, Lyn, so I think you and I were talking the other day and about how the election is going to impact people's portfolios and trying to really think that through. So we're going to dive into it today. And I think we're going to go from the macro overview down to the nitty gritty. And what I want to encourage everyone to do when they're thinking about whether it's Biden or Trump or a red Senate, blue Senate, is think about how important the stimulus and the government put, as you and I have been referring to it lately, how important those factors are to the market. And although fundamentals do play a role, I think we really, really, really need to think about the macro as much, if not more now than we ever have to in the past. What do you think?
Yeah, absolutely. I mean, this has been a key year for macro, and it's enough to historically it's been enough to look at different stocks and different assets and look at them on their individual merits. Is this gaining market share? Is it appropriately valued? How's the balance sheet? But this has been just a game changer, just due to how much stimulus came in, how big of an economic shock we had from the pandemic. And something I've been covering for a while is that a lot of analysis is looking at the pandemic as though it started everything, whereas we actually had kind of a trend already forming. So if you look at the chart I have up here, it shows that historically, if you go back decades, you start to see a trend where deficits tend to widen during recessions, right? Because you get a decrease in tax revenue, you get a increase in federal spending for stimulus programs, things like that. And then during an economic expansion, you get a narrowing of that deficit as a percentage of in particular. Now, the last like 3 years or so prior to the pandemic, so from about 2016 to about 2019, was a major divergence from that, because we started to get a sharply rising deficit, both in absolute terms and as a percentage of GDP, without having a recession. We have to go back actually to the 1960s, the Vietnam War, to find a period where we had that happen. And that's kind of where we are in terms of the long-term debt cycle.
And I always like to point out when we're talking about war and deficits that those are one-time expenses. They're not recurring. It's like running a business where you have an advertising cost. That can be a one-time expense, but your payroll, that's going to be there for a long, long time. And that's the big difference I see now. And it's shocking, Lyn, that we had these huge deficits and the deficits getting increasingly bigger when we had the best economy in all U.S. history, according to Trump's Twitter feed, right? It's weird how that works. But anyway, okay. All right, so we got the next chart here, S&P 500 measured in dollars and gold. This is really interesting. You've been doing this more than any person on FinTwit, is really taking these charts and juxtaposing them to the price of gold and then also M2 money supply. So you want to walk us through this?
Yeah, so people often, look at the stock market in terms of dollars, which normally makes sense. But during periods of currency devaluation or notable monetary policy changes, one potentially better way to look at it is gold price. The S&P 500 price in a variety of hard assets. So whether it's gold or silver or something else that is finite. And so what this chart shows, the blue line is a chart that a lot of people are probably familiar with, based on its shape, which is the S&P 500 over the past 5 years, and that's priced in dollars on the left axis. Now, if you look at it, however, in priced in gold, right? So how many ounces of gold it takes to buy the S&P 500, that's actually it peaked back in 2018, and it's been on a multi-year decline ever since. And so one way to look at that is that's kind of where the stock market is with stimulus removed, right? Because the way that stimulus worked this year, of course, is that the government ran very large deficits. They sent out stimulus checks. They did extra unemployment benefits. They did PPP loans to small businesses that turn into grants. All these sorts of things, and there wasn't really a lot of buyers for those treasuries to fund all of that. So the Federal Reserve created new bank reserves to buy a lot of those treasuries. And so we basically greatly expanded the broad money supply, and that propped up a lot of assets. Now, but that in addition to propping up stocks, that also propped up gold and other things as well. And so what we saw essentially was that the stocks did well in dollar terms, but they did rather poorly when compared to harder or more defensive assets such as gold, as this red line shows.
Yeah, great point. And this is, again, why we really need to be cognizant of the stimulus that's coming out of the government. And if we got a Biden victory, we got a Trump victory, then paying attention to the Senate to see how much stimulus they can actually pass.
Yeah, what I have on this next chart here is it's a similar thing. This is the S&P 500 as priced in silver, but what I did here is look at it over a full 50-year period, and the trend line on there is a 50-month moving average. So it's a very kind of long-term structural trend. And what we see on the right there is that the S&P 500 as priced in silver broke below its 50-month moving trend line this year, and that's the first time it did that since 2002, which of course was the early phase of a multi-year precious metal bull run. And so something I've been highlighting for a while is, ever since 2018, gold moved first, of course, which is normally what happens. So gold started making, it started to rally pretty hard, and so the S&P 500, as priced in gold, started making lower lows and lower highs. And of course, it had those corrections along the way. So there were periods of correction in the gold price, and we had rallies in the stock market. But overall, we had a trend shift towards gold outperforming the S&P 500. And now, it took a little while longer, but we started to see that with silver as well this year. And so my long-term expectation is probably that we're going to see over the next, call it 3 years or 5 years, that we're probably still going to see some pretty strong performance from many of these commodities, especially ones with a monetary component, but also as well potentially many of the industrial commodities.
Got it. Yeah. So bottom line here is make sure that you own some precious metals for sure.
I also show here, it's a similar chart of priced in copper, and it shows that even with the monetary element removed, it's starting to look pretty interesting, because while this one has not broken below the 50-month moving average, it is, starting to get pretty close to that and is looking somewhat toppy. And if you look at, I've done deep dive analysis on copper industry and copper stocks, and there is kind of a long-term supply deficit beginning to form. Because despite very large exploration budgets over the past decade, they've not really found a lot of new major deposits. And plus, the copper price just hasn't been at a level that really incentivizes a lot of new mines coming online. And so it's starting to get tight. And we've actually had some surprising strength out of copper this year, despite, the obvious economic slowdown. So I think this is another metal to watch, especially, the gold to copper ratio is historically high, meaning that copper is pretty cheap relative to gold, because gold, of course, had a very strong kind of fear-driven rally and based on low interest rates over the past 2 to 3 years, whereas copper is just starting to wake up a little bit. And so, I think that, again, over the next several years, that copper has a pretty good period ahead of it.
Yeah. And the main takeaway I think here is commodities are really cheap. I think commodities are at a historic low relative to the S&P 500 going all the way back to 1900. And so, and also too, prior to the virus coming out, there wasn't that much that was actually cheap, but now there's some more opportunities when we're looking at these charts.
And one thing I'll do for these 3 slides, and then I'll turn it back to George, is to kind of give an example of what 3 different stocks look like in this market, because it shows some of the bifurcation that's happening and where some of the risks and the opportunities are. So this one is Amgen. So it's a large cap a healthcare stock, biopharmaceuticals. They're an increasingly diversified company, and they got added to the Dow early this year. So they're kind of firmly in the blue chip camp at this point. They have a strong balance sheet, investment grade. And so what this chart shows, this is called a fast graph. And what this shows is the orange line and the blue line. So there are different ways to measure valuation. And they show, so the orange line, for example, shows if the stock had a 15 earnings multiple, so price to earnings ratio, and so the chart, of course, takes into account earnings over time. It also includes 2 years of forward consensus analyst expectations for earnings. The white line going up is the dividend. And so what this chart shows is that fundamentals, as represented by earnings multiplied by 15, the orange line, has been in a very strong upward trend. So, earlier, this is a 20-year chart. So earlier in the period, that was when Amgen was in a rapid growth phase. It got pretty overvalued there. Then it consolidated for many years sideways, even though fundamentals kept doing well, because that's what happens often when you start with a period of high valuation. But then, about a decade ago, they really kicked it into high gear. They began diversifying their products a lot, coming out with a lot of new products. And so they've been in a very strong uptrend, both in terms of fundamentals and price. But what this shows is that essentially the stock has been extremely rational in the past several years, where it's gone up almost perfectly in line with fundamentals. So as earnings grew, the stock grew. And of course, it had some degree of volatility around that average, but overall, it did pretty much exactly what you'd expect it to do. So you can buy the stock for, roughly 15 times earnings. You get a yield that varies between 2.5% or 3%, and it's just a kind of a long-term compounder as a potential.
Yeah.
So that's kind of what you'd expect from a normal stock. Now, this is an example of, everyone knows at this point, I think, that tech did very good this year. But, some of them had their fundamentals kind of go parabolic this year. For example, Zoom had a very good year just because so many people had to begin using that. But there are many other tech stocks like Apple where, as far as fundamentals are concerned, this year wasn't really anything special for them. They were neither hurt by the pandemic, nor were they, kind of gifted, a ton of new business. And this is, of course, a $2 trillion company. So it's very hard to kind of move the bottom line in terms of growth. And so they actually had pretty flat revenue this year, and most of their earnings growth came from buybacks. So what this chart shows is that it's only the price, the stock price, that went parabolic. So you see the black line going up dramatically, literally vertically, while
Mm.
their fundamentals, as represented by the blue line, which is their average price to earnings ratio over their earnings, or the orange line, which is their growth rate. So that the orange line would represent a 17 and a half earnings multiple or price to earnings ratio. And it just shows a complete decoupling of the stock price from fundamentals. And of course, there's always reasons to justify this to some degree. So for example, interest rates came down, so that can force the stock price up. In addition, Apple has transitioned more and more towards services and software revenue, and those types of companies tend to get a higher earnings multiple than hardware-based companies. So there are some reasons to justify somewhat of a valuation increase, but it is rather challenging to justify a 35 price to earnings ratio for a company that really doesn't have much revenue growth at this point. Very, very kind of sluggish revenue growth, and a lot of its per share growth is coming from buybacks.
Yeah.
And then as my last slide here, this is the opposite example. So this is Enterprise Products Partners. It's a midstream company, technically a partnership, and they transport crude oil, natural gas liquids, which are used for plastics and all sorts of different products that we use throughout our lives. And so what this shows is that they've actually had the opposite scenario of Apple, where the pandemic hurt them a little bit, right? So they're not very vulnerable to the prices of their commodities. So they're mostly focused on how much volume they're transporting. So that was only moderately impaired this year. So they've actually still been doing quite well fundamentally. They've been able to maintain their high distribution, which is currently over 9% per year. They have the highest investment grade rating in the midstream industry at triple B plus. And they've historically done very well. And so what you see is that the stock price fell off a cliff this year. So it's one of the cheapest it's ever been in terms of valuation. You can call it, enterprise value to EBITDA. You can call it the dividend yield. You can call it price to cash flow, multiple ways to value it. But as this chart shows, the black line of stock prices fell deeply below fundamentals, which are represented more by the blue line or the orange line, depending on which valuation metric you want to use. And what this shows essentially is that, if you look at many types of commodity companies, whether it's some of the high quality producers or some of the high quality transporters like Enterprise, many of them have just been sold off. I mean, the market has just been relentless at piling into tech at any price while selling off these, even the ones that are in better shape than some of their over leveraged peers or some of their worst run peers. So I'll bring it back to George here. But this just kind of shows that there are kind of still opportunities in the market, especially if you look into the less crowded spaces.
Yeah, I mean, this is just a great example of what we're talking about. You've got to start, I think, with analyzing the election to determine how much stimulus is going to be coming down the pipeline in the future. But then you have to take the next step and realize that there are still opportunities and do that bottoms up research. And if you do the homework and if you do the work, there are some cheap companies out there that no one is paying attention to and could be great opportunities for someone's portfolio, especially at a 9% dividend yield. Wow, that's really, really great. So I think that's really the takeaway. You start with the macro, can't ignore it anymore. If you're looking at broad S&P 500, look at the stimulus, but then keep digging and digging and digging because you're going to find some golden nuggets out there.
And I think that can end the core part of our presentation, which leaves us time to answer any questions that the audience might have.
All right, Lyn, George, thank you so much for that presentation. We do have some time here for some questions. Let's see, we had a viewer writes in reference to the chart on the S&P that you showed, does that factor in dividends?
That one does not. That is just the price itself. However, you have a similar chart if you priced in dividends because that's only been a few percent per year. It's actually like 2% or so, whereas that's been a very large divide. So it would look roughly the same. However, over multiple decades, that's when dividends do become extremely important.
All right, another viewer writes in, they're wondering, what about gold miner ETF GDX, or is it better buying individual gold miners?
I personally do both. So GDX is a it's kind of the go-to for that industry. You get a good mix of the royalty companies and the large cap miners, most of which I think are pretty solid. Now there are of course specialists that go deep onto individual smaller miners. So if you're highly interested in the industry, there are people you can follow that really go into that level of detail, and you can potentially get outsized gains in terms of for in exchange for some more risk. So I actually do a blend of both. I have, several individual miners that score a little bit higher on the quality metrics, but I also use GDX just to also have just some broad industry exposure as a macro play.
All right, thank you so much. Another viewer writes in, they are asking, what's your view on wine stocks, if any, U.S. or international?
George, do you have any thoughts on wine stocks?
Well, if the economy is going to go where I think it's going to go, I think people are going to be drinking a lot more. So you might want to look. No, I seriously, I don't, but I like things that are defensive, and I like things that are going long volatility. Everyone has read Chris Cole's paper. I think it's fantastic for the Dragon portfolio, but the difficult part there is to figure out how can the average Joe or Jane go long volatility, because it gets very complex when you're dealing with options. And I think if we can just get outside of the box and think about things that would do well if we have not only volatility in the stock market, but also volatility in the real economy and with social unrest, which is what we've been seeing recently in 2020. And I think it'll continue or maybe even get worse in 2021. So that would be potentially things like alcohol, cigarettes. Lyn and I have talked extensively about Altria and tobacco stocks in Rebel Capitalist Pro, and Altria is the best performing stock in the stock market since 1968. So, and then if you want to get even further outside of the box, if you look at trailer parks, RVs, if you're a real estate investor like I am, I think those are the things you have to start looking at to really protect your wealth. I think it's moving forward. You can try to get growth and increase your wealth, but I think first and foremost, you've got to protect it. And those who have a mindset and their first priority is protecting their wealth over the long run, they're going to do much better.
Yeah, one thing I'll add is that, uncorrelated diversifiers can be very helpful in general. And so, the classic kind of 60-40 portfolio is just very kind of long on the U.S. economy, right? So you invest in large cap companies
And
and you
it's
invest in.
short volatility.
Yeah, pretty much. But by adding some diversifiers to a normal stock and bond portfolio, whether it's gold, whether it's international stocks, whether it's things like silver, Bitcoin, whatever the case may be, and wine in particular. I know George, you just interviewed Keith McCullough on Rebel Capitalist show. He's actually a big wine collector. He often points out that wine has one of the best risk-adjusted returns over the past whatever time period, 5 or 10 years. And so that's an example of an uncorrelated asset. That's different, of course, than a wine stock. But wine itself, a fine wine, of course, is actually an uncorrelated asset similar to precious metals, farmland, whatever the case may be, that's different from the typical S&P 500.
Or 1990s Ford diesel pickup trucks. Which for the viewers who don't know, that's kind of the thing that I enjoy collecting, like wine, that I always argue it's just like gold. It's a store of value and it'll go up and up. And I gave Lynn a hard time the other day because I asked her a question. Try to think of an asset that actually where the supply goes down over time. A store of value asset where the supply goes down. And she couldn't think of one because even artwork, you got a fixed supply, but those diesel pickup trucks, 1990s Ford 73, I won't go into them, but they're a store of value. And over the last year or so, they've just skyrocketed in price. So anyway, there's a lot of ways to get outside of the box. And I think that's the takeaway there.
All right, excellent. We do have another question that came in here. Actually, a few of them were inquiring about this on Bitcoin. This question says, Lynn, I'm a subscriber, so know your thoughts. I know your thoughts on Bitcoin. Wondering yours and George's view on it as a safe haven asset, and would you plan to trade or just hold? Same with gold. If you own physical gold or silver, do you hold or view as a trade?
So for me, it's a tiny bit of both, but emphasizing hold. So with gold, one thing I emphasize is having layers. So physical, coins and bars is a form of kind of insurance out of the financial system, kind of personal custody or vault custody. But then of course you have ETFs and gold miners that can provide more liquid vehicles within brokerage accounts. And those, I still like to have a multi-year holding period. But there are certain points where I would sell if I thought they were overbought and if there were better opportunities I could rotate into. So I kind of view that as different vehicles for different purposes. And then for Bitcoin, similar thing. So I plan to hold. For people that haven't followed the market, I analyzed it several years ago. I didn't take a position. It had a multi-year kind of consolidation correction since then from that hype bubble that happened in 2017. But I did go long earlier this year in April, and so I've been quite bullish on Bitcoin as a diversifier, and it is up significantly this year. But I still think it probably has a good room to run in 2021. I do think by the end of the year, I'd be very interested in rebalancing some of those gains into other asset classes, if indeed the bull run stays solid through that point. So I think there's a case made for maintaining a hold position in an asset like that. But also if it grows, bigger as a percentage of your portfolio due to outperformance, it's not a bad idea to kind of rotate some of that into other assets to not being overweight beyond your risk tolerance.
Yeah, for me, I just look at gold as an insurance policy. So I like to allocate 10% of my portfolio to it. As far as Bitcoin or the gold miners or miners in general, I look at them as speculative asset classes. I don't really see gold and Bitcoin competing. And I don't think Bitcoin is a store of value. I think it's too volatile. It doesn't have enough history. But that's not to say that I don't think you should own it. I absolutely do. but I just don't see it as that type of asset. I don't think it competes with gold. I think it's a complement to gold. And I think that really hits on why it's so important to first and foremost think about portfolio construction. I know Lynn and I answer these types of questions constantly, and people like to get super fixated on a specific asset and is it going up or down in price? And they completely ignore how that really plays with the rest of their portfolio. And I think that's one thing I'd like to encourage everyone to do is make sure that you're cognizant of portfolio construction. Most people give that about 1% of their mental bandwidth, and they allocated about 99% to trying to figure out what's going up or down. And I think if they could maybe have more of a 50-50 split in the long run, they do a lot better. What do you think, Lynn?
Yeah, absolutely. I think one of the biggest things that people over allocate to one specific asset class at a time, and that just, it's kind of a recipe for if you're wrong on a thing and you lose kind of 30% of portfolio, that's much harder to recover from than having a set of bets and you're bullish on all of the different bets, but you can still be, wrong on one or two of them and the other ones work out fine. And to not, chase price unless you, of course, have a very specific kind of momentum-based price model, which some traders do.
Yeah, and I think we all have to be cognizant of our own shortcomings. And as human beings, our biggest enemy is ourselves and our own emotions. And so if you've got 30, 40, 50% of your portfolio in one asset class, you got to ask yourself, are you going to be able to sleep at night? And if the answer is no, then you should probably adjust that. Or, said another way, if you've got too much allocated to one asset class and that's going to make you, it's going to force you into making emotional decisions, then you need to reevaluate. I like to have a portfolio that's diversified enough to where I don't even want to check it. I'll go months, I'll go years without even checking the price. In fact, I was listening to a podcast with my favorite investor of all time, Jim Rogers, and he was telling a story to Grant Williams and Bill Fleckenstein about when he invested in a small African country. I forgot which country it was. But the broker, when he bought all the shares, said, do you want me to send you a statement every month or once a year or something like that? I said, absolutely not. He goes, whatever you do, don't send me a statement. I don't want to know what the price is doing because that will force me to make a bad decision because I'll get emotional about it. And I think we can all learn a lot from that story.
All right, thank you so much. Another viewer is writing in. They're wondering how would a vaccine impact our macro theory in buying gold stocks?
One thing I'll add to that is that we saw the vaccine news in the past couple of weeks here, and so you have, of course, had the immediate sell-off of stay-at-home stocks. You saw kind of a trimming of defensive assets like treasuries or gold, and you saw kind of a rally in some of the value stocks. And to some extent, that's rational because now you have new information about potential kind of a positive outcome in 2021. However, gold is the case for gold. I started investing in gold in 2018 for this cycle, and so it began rallying far before the pandemic. And so gold is mostly correlated to real yields, so inflation adjusted yields, whether it's yields from a bank or most appropriately a 10-year treasury yield, because that's kind of considered a long-term kind of saving vehicle. And so when you compare that, gold is strongly correlated to real yields inversely. So whenever real yields are high, meaning, for example, if inflation's 2% and you can get 4% for holding a treasury bond, that's a kind of a good reason to hold a treasury bond. And it means there's a lot of opportunity cost if you want to hold a yieldless asset like gold. However, when treasury yields are yielding less than inflation, you have a negative real yield. So you're losing money over time. And so in that environment, scarce yieldless assets like gold or silver, or potentially some of the more speculative ones like Bitcoin, they can do very well in that environment because investors are willing to pay up for that scarcity because they're not getting a real yield from some of those other savings vehicles. So my outlook continues to be, negative real yields for most of the next, call it 5 years. But there will be corrections along the way. There will be bull runs. So I'm still viewing it as a long-term outcome, pretty much regardless of the a vaccine potential. But I don't know if George has any thoughts.
I think you've got to look at it like going out hiking when it's 120 degrees, right? You might get a vaccine and that takes us down to where you're going hiking and it's 110 degrees. But regardless of the 10-degree difference, you're still going to need a hell of a lot of water. And so that's the way I would look at a vaccine, gold, and the continued money printing from the central banks and the government stimulus. It's going to be there. It's just a matter of to what degree. And regardless of the degree, you're going to want to own precious metals. You're going to want to have some sort of insurance against the devaluation of your cash.
All right, thank you so much. Just have about a minute left here. George, one of our viewers was writing in. They're wondering, what's your general outlook for the housing market over the next 2 to 3 years?
Well, I think the housing market has to come down, adjusted for inflation. And that's the key. So the next question becomes, okay, does it go down in nominal prices or does it just go down in real prices? And that's a tough thing to determine. But I think that's how you have to start looking at it. You got to look at the supply, but then you just have to, I think with a Biden, I went over this in one of my videos the other day. I think with a Biden victory, you have to look at the constraints that the builders have. And when you look at single family housing, especially starter homes, they're just not going to be making any more of them. So if I had to kind of weigh the probabilities as to, housing prices coming down in real or nominal terms, I'd probably just say in real terms. And another thing I'd point out to all the viewers is if you're trying to figure out the housing market, just remember, when you have a crash in housing, whether it's nominal or in real terms, it doesn't happen overnight. Even if we go back to 2000, the GFC, from 2006, we hit our peak in housing. We didn't hit our bottom until 2012. It just takes a long time. In Japan, same thing. It took them many, many years to hit their bottom in housing from their peak in, call it 1990. So I don't think you should get really speculative with housing. I don't think now is the time to get aggressive because it is expensive. That's the bottom line. But I think that if you can find something at the right price, the right neighborhood, I'm talking about a rental property, and you can get a really good deal, you can find a motivated seller, then there is some opportunity, but the opportunity exists more so in the debt, not in the asset. Because what's cheap right now is 30-year fixed rate mortgages. And if you can secure an expensive asset that has positive cash flow with that cheap debt, I think even if you lose a little bit on the asset, you're going to make up for it and make even more money on the shorting the dollar through the debt, which is the 30-year fixed rate mortgage, because you're paying it back in cheaper dollars.
All right. Well, Lyn, George, that puts us right about at time. We greatly appreciate you joining us today. Thank you for taking your time out and addressing our audience. It's really, really appreciated.
Yeah, thanks for having me.
Thanks for having us.
All right. Thank you. Have a great evening.